Welcome to Knowledge Fulmination. Today's hot topic is about investing mistakes, so let's begin. Here are 10 mistakes that successful, wealthy investors tend to avoid. First, not diversifying their portfolios. Successful investors know that diversification is key to minimizing risk and maximizing returns over time. They invest in a range of assets, including stocks, bonds, real estate, and other investments. Diversification is a key strategy that many successful investors use to minimize risk and maximize returns over time. Diversification involves investing in a range of assets, such as stocks, bonds, real estate, and other investments, to spread out risk and minimize the impact of any one asset class on overall returns. By diversifying their portfolios, wealthy investors are able to protect themselves against market volatility and ensure that their investments are well-positioned for long-term growth. Second, letting emotions drive their investment decisions. Successful investors understand that the stock market can be volatile and that it's important to stay focused on long-term goals rather than short-term fluctuations. They avoid making rash decisions based on emotions or fear. Stick to your investment plan. Before making any investment, it's important to have a well-defined investment plan that takes into account your financial goals, risk tolerance, and time horizon. By sticking to your plan and avoiding impulsive decisions, you can stay focused on your long-term goals and avoid being swayed by short-term market fluctuations. Avoid herd mentality. It's important to avoid making investment decisions based on the actions of others or on the latest market trends. Instead, make decisions based on your own research and analysis, and don't be swayed by fear or greed. Keep your emotions in check. Emotions can be powerful drivers of investment decisions, but they can also lead to poor decision-making. Before making any investment, take a step back and evaluate your emotions to make sure that they're not clouding your judgment. Maintain a long-term perspective. Investing is a long-term game, and it's important to maintain a long-term perspective when making investment decisions. Avoid getting caught up in short-term market fluctuations, and instead focus on the long-term potential of your investments. Use a systematic approach. One way to avoid emotional decision-making is to use a systematic approach to investing, such as dollar-cost averaging or rebalancing your portfolio on a regular basis. These strategies can help you stay disciplined and avoid making impulsive decisions based on emotions. Fourth, chasing trends or hot tips. Successful investors don't invest based on the latest trends or hot tips from friends or colleagues. They make investment decisions based on careful analysis and research. It's important to note that not all wealthy investors chase trends or hot tips. In fact, many successful investors avoid these strategies and instead focus on a long-term, disciplined approach to investing. That being said, some investors may be tempted to chase trends or hot tips in the hopes of making a quick profit. However, this can be a risky strategy, as it often involves investing in assets or industries that may be overvalued or experiencing a short-term boom. Some reasons why investors may be tempted to chase trends or hot tips include fear of missing out. FOMO investors may be afraid of missing out on a potentially lucrative investment opportunity and feel pressure to act quickly. Confirmation bias. Investors may be influenced by news articles, social media, or other sources that confirm their pre-existing beliefs about a particular investment opportunity. Lack of knowledge. Investors may not fully understand the risks or potential downsides of a particular investment opportunity and may be swayed by hype or positive media coverage. Pressure to perform. Investors may be under pressure to generate high returns or meet certain performance targets, which can lead them to take on riskier investments. Fifth, focusing on short-term gains. Successful investors know that building wealth takes time and they focus on long-term goals rather than short-term gains. Setting clear financial goals. Rich investors typically have well-defined financial goals that they work towards over a period of years or even decades. By focusing on these long-term goals, they are less likely to be swayed by short-term market fluctuations. Diversifying their portfolio. Wealthy investors often diversify their portfolio across a range of asset classes, including stocks, bonds, real estate, and alternative investments. This can help them weather short-term market volatility and achieve more stable, long-term returns. Investing in quality companies. Successful investors tend to focus on investing in high-quality companies with strong fundamentals and a proven track record of success. By investing in companies that are likely to perform well over the long term, they are less likely to be swayed by short-term market fluctuations. Avoiding market timing. Rich investors generally avoid trying to time the market, as this is a notoriously difficult strategy to execute successfully. Instead, they tend to take a buy-and-hold approach to investing, focusing on quality investments that they can hold for the long term. Staying disciplined. Successful investors tend to have a disciplined approach to investing, sticking to their investment plan even in the face of short-term market fluctuations or economic uncertainty. By staying disciplined and avoiding emotional decision-making, they are better able to achieve their long-term financial goals. Sixth, trying to time the market. Successful investors don't try to time the market or make predictions about future market movements. Instead, they focus on building a diversified portfolio and staying invested over the long term. Technical analysis involves analyzing past price and volume data to identify patterns or trends that can help predict future price movements. This approach may be used by some investors to try to time the market, although it is generally considered to be a less reliable strategy than fundamental analysis, which focuses on analyzing the underlying financial and economic factors driving a company or asset. Another strategy that some investors may use to time the market is to focus on macroeconomic trends or indicators, such as interest rates or inflation. By analyzing these trends and attempting to predict how they will impact the market, investors may attempt to buy or sell assets at opportune times. However, it's important to note that market timing is a risky strategy that is difficult to execute successfully. Even experienced investors and financial professionals often struggle to accurately predict short-term market movements, and attempting to do so can lead to significant losses. As such, many wealthy investors tend to take a more long-term approach to investing, focusing on quality investments that they can hold for the long term, rather than trying to time the market. By staying disciplined and avoiding emotional decision-making, they are better able to achieve their long-term financial goals. Seventh, ignoring fees and expenses. Successful investors pay close attention to fees and expenses associated with their investments, and avoid high-fee funds or investments that eat into their returns. Invest in low-cost index funds. Index funds are designed to track the performance of a particular market index, such as the S&P 500. Because they are passively managed, they tend to have lower fees than actively managed funds. Wealthy investors may choose to invest in index funds as a way to reduce investment fees and expenses. Negotiate fees with investment professionals. Wealthy investors may be able to negotiate lower fees with investment professionals, such as financial advisors or fund managers. By shopping around and comparing fees among different providers, they may be able to find providers who offer lower fees. Avoid unnecessary fees. Some investment products, such as annuities or certain types of mutual funds, may have high fees or hidden costs. Wealthy investors may choose to avoid these products in favor of lower-cost options. Use tax-efficient investment strategies. By investing in tax-efficient strategies, such as tax-deferred retirement accounts or municipal bonds, wealthy investors may be able to reduce their overall investment expenses over time. Eighth, not having a plan. Successful investors have a clear plan and strategy for achieving their financial goals, and they stick to it over the long term. Set clear investment goals. Wealthy investors start by setting clear investment goals. These goals may include targets for investment returns, risk tolerance, and time horizon. By setting specific goals, they can develop a clear investment plan to help achieve those goals. They may adjust their portfolio allocations or investment strategies based on changing market conditions or other factors. Seek professional advice. Wealthy investors may seek advice from professional financial advisors or investment managers to help develop and implement their investment plan. These professionals can provide expert guidance on investment strategies. Stay informed about the latest market trends and economic indicators. They closely monitor market conditions and use this information to inform their investment decisions. Taking on too much risk. Successful investors understand their risk tolerance and invest accordingly, avoiding investments that are too risky or outside their comfort zone. They also diversify their portfolios to minimize risk. Wealthy investors tend to invest in quality assets that have a proven track record of generating stable returns over time. Use risk management strategies. Wealthy investors often use risk management strategies to protect their investments from potential losses. For example, they may use hedging strategies, such as options or futures contracts, to offset potential losses in their portfolio. Have a long-term perspective. Wealthy investors tend to have a long-term investment perspective and are less likely to make short-term investment decisions based on market fluctuations. They understand that investing involves some level of risk and that over the long term, a well-diversified portfolio of quality assets can generate solid returns. Well, that concludes it for today. Thanks for watching.